Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, today I'm honored to welcome Ben Reinberg to the show. Ben is the founder and CEO of Alliance CGC, which is a commercial real estate powerhouse. Now, Ben's journey, which we'll talk about today, began back in the accounting space and has since grown into a commercial real estate career with decades of experience building and managing a very diverse portfolio. Now, under Ben's leadership, Alliance has grown into a firm recognized nationwide for its focus on medical, retail, industrial, office, and multifamily property. So today, guys, we'll take some time, dive a little bit into Ben's roots, really hopefully unpack what fuels Alliance's success. And hopefully we can hit on as well some market trends that are shaping the future and maybe some of the challenges and potential opportunities that are, that Ben sees on the horizon. And so Ben, welcome to the show, my friend. It's a pleasure to have you here.
Kevin, thank you so much for having me. I really appreciate it and look forward to adding a lot of value to your audience and talking shop and
Yeah.
talking about commercial real estate.
Well, let's make it happen. So how about we back it up a little bit? I gave you that's a fairly brief introduction. I know there's a little bit more to the story. I know that you'd referenced before we start recording here. You grew up in Chicago. Maybe talk a little bit more of your upbringing and how those, I guess how those early years really shaped your journey into the real estate world.
So I come from Chicago and I'm from the north suburbs, and I didn't come from money. And when I was younger, I was always very entrepreneurial between selling cigarettes in bars when I was really young to there was no internet. So it was all about hustle, street hustle, and making
Yeah.
money and playing sports. And so when I was a kid, uh, I had to figure out how to fix my sugar fix because my reward when I was a kid was candy and sugar. So I had a 7-Eleven down the street. I had to figure that out. So I started my entrepreneurial career to be able to afford candy and Slurpees. That was my goal. And then as I matured and got older, I realized I wanted to continue to build wealth. And being from Chicago, I saw all these iconic families like the Pritzkers and the Crowns and the Zells of the world. And there was just hundreds of them, billionaire families, really well off. And what I realized is they all invested in hard assets,
Mhm.
which is interesting because that's my new book, Hard Assets and Hard Money for Hard Times. And so hard assets have been prevalent in my entire life. And so when I saw this coming from Chicago, I said, how do people generate wealth? And it's through hard assets like commercial real estate.
Mhm.
And so my goal was, how am I going to learn how to invest in commercial real estate? So when I started my career, I was a CPA. I did it for a year, Kevin. I hated it. I went through a tax season, realized it's not for me. I need a pivot. And so for everyone out there listening, if there's something you're not satisfied with, pivot. And it's what I did. And so I pivoted, started Alliance, decided I'm going to start buying hard assets. That's where the money is. When I was on audit, when I was working for the CPA firm, I had a billionaire out of New York basically tell me, you're more of an entrepreneur. You really should start your own business. And so that's what inspired me. And he was one of my influences. And then I took a step back and said, okay, well, when I started in the business, I said, well, what assets are prevalent in the Chicago area? There was no internet. So it had to be a local regional. You're either going to drive or walk to whatever you're going to look at. And so it became a local and regional business, and that's where my resources are. And for everyone out there listening, when people ask me, well, how do you get started in commercial real estate? I don't care if the internet's prevalent and you are from Chicago and you go invest in Florida like we do now in 30 different states we're in. The difference is when you're getting started, start locally. People ask me, well, why would I do that then? Well, it's real simple. Your resources are there.
Mhm.
You can canvas easier. You can, it's more affordable. You can preserve your cash instead of spending on travel and hotels and everything else you need to do. Mm-hmm. So start locally, find a niche that meets your area. So, for example, you might be in an area that self storage is great. Mobile homes is another great asset class. It could be medical office, like one of our niches, or industrial. Like when I was in Chicago, living in Chicago, industrial and office were prevalent when I was in my 20s. So that's what I started cut my teeth.
Mhm.
All my friends were getting into multifamily. I said, I didn't want to do that. I want to do something different. So do something different and take a risk and the worst thing you can do for people out there is, God forbid you fail. You're just going back to where you started. So you have nothing to worry about if you fail. And that was my understanding when I was younger in my 20s, starting commercial real estate. So we started in office and industrial. We built over 12 million square feet. We syndicated, and we've been buying assets ever since. And then 23 years ago, on my 32-year career, we started buying medical because I thought I was going to be the next Sam Zell. My goal was I was going to buy skyscrapers. I was going to own office, being from Chicago. I was going to succeed what he was doing. And then the internet became prevalent. People didn't need as much office space, and the world changed. And I realized, Kevin, like I have to change. So I just took a step back and realized that the human body is never going out of style. And medical office was a prevalent asset class for us to get into. We did, it was great. We expanded on it. Every single niche within that you and your family would use, that's what we own. And it's become a wonderful tool. And then in 2024, we decided we're going to open up a multifamily division because there's a lot of opportunities. For everyone out there that don't know, there's trillions of dollars of debt that's coming due in 25 and 26. And so that's going to have a disruption in the market, especially in commercial real estate. So we think there's a lot of buying opportunities. So if you're looking to invest passively with someone like Alliance, like what we do, or even like with Kevin or whoever, it's a great time to invest in commercial real estate over the next 5 years. Why? Because these are buying opportunities we're not going to see for a long time. So I am a commercial real estate expert. I'm a principal. I own, we manage, and what we do is we produce great results and track record for high net worth accredited investors and family offices all throughout the world. And so that's what I do. That's a little bit of my background. You know, there's nuances in between, but and that's why when we talk about the book, I tell people if you're looking to build a hard asset empire, it's a good tool for you. But it's also I teach people how to invest with smart money. So, for example, if I'm going to invest in your specialty, I'm not going to do it because I'm not the expert. I'm going to invest capital with Kevin. That's just how it works. And so, what happens is I tell people focus on your niche, whatever that is. You could be a marketing executive, you could be a janitor. I don't care what your industry is. Become the best version of that person that you want to become. Then when you have capital invest with smart money, like Alliance, if you're investing in medical or multifamily or industrial, whatever we do, that's smart money. We've been there, done that, have a track record, and it's transparent. So in order to build wealth, which I've been asked a long time, how do I do it? Is you got to invest with smart money and you got to focus on your niche.
Yeah. No, I love that. There's a lot to unpack there, Ben, but I'm gonna try to hit on the salient points. I'm gonna back it up a little bit though to I guess that the first deal, and you really emphasized investing locally, and I agree with that. I mean, I think that another thing that you have when you invest in your backyard is you have an intimate knowledge that others don't, and you have an intimate knowledge, you know, where you live that you will not have. I don't care how many data points you go by, what demographic, you know, resources you use. It never fully replaces or gets you the entire picture like intimate knowledge, localized knowledge does. And so I do agree that if you're just getting started, that don't be opposed to finding something in your backyard that makes sense, because more than likely there's a ton of opportunity. You just got to dig for it a little bit, you know. Bigger cities, maybe like a Chicago, maybe a little easier, right? Larger population, more buildings, generally speaking. But again, I think that's irrelevant. I think there's opportunity all around you, no matter where you live in the country. Let's talk about that first. I want to hear about that first deal. So, what did you end up? What did you end up buying? What did you decide upon? I know originally you wanted to, you know, move your way into, you know, having the trophy assets, the skyscrapers, and all that. But you know, where'd you land on that very first deal? What was the first commercial deal?
First deal I syndicated was an industrial building. It was
Okay.
95,000 square feet. It was probably 15, 20 minutes from my home. And so it was familiar. It was next to a naval base that they were developing. So the whole area was going to get revamped, and with townhomes and residential and community centers and retail and industrial and office all in this development next to where we bought. So we bought a 95,000 square foot industrial building. The first week, I lost 45% of income in the property. Someone just moved out in the middle of the night. Okay. And I bought it from two icons that were the largest home builders in the United States that own commercial real estate as well. And so it was a great negotiation. I got a credit for the roof and the parking lot and all these different things. What ended up happening was I got thrown into the deep water quickly when you lose 45% of your income.
I'd say so.
And for everyone out there listening, it's not how you react, it's how you respond to challenges in life. And that was really one of my first challenges in commercial real estate. And think about it, I raised, Kevin, probably over almost $2 million, okay, as a young man, okay, with shoe leather. And so I had a lot to ride on because people were depending on me. It's my first deal. So I ended up backfilling it. I make a two-tenant industrial building, a three-tenant building. And then about 4 years later, we sold it for a 3x multiple. And that's what launched me.
Okay.
But what
I
went
love it.
on during that deal was so many lessons about property management, asset management, negotiating leases, negotiating renewals, financing, managing investors' expectations and paying returns and how to deal with things and suspending returns. All the things you go through in a deal, I was thrown in the water on that first deal. And when I got through it, I realized that, you know what? It's not going to be perfect life. But if you hang in there and you do the right things and communicate well to everyone and you work hard, you're persistent and reliable, everything else will work itself out.
Yeah.
And communication is tremendously important in our business. And so I learned a lot from that deal and it catapulted me to where I am today.
What was it? Was there something missed on the during due diligence of, I know you said that tenant left within the first couple of days. What, I guess ultimately what occurred there? And it sounded like that wasn't part of the business plan. I guess what was the original business plan and what caused that to alter? What caused that tenant to get up and leave?
Yeah, the original business plan, we're going to renew the two tenants and then eventually sell it. That
Got it.
tenant got up and left because they were looking at potentially some issues in their business. Things were changing in the automobile business and what they did. And so they realized they just couldn't make it anymore. And in the due diligence, one of the issues we probably had is we didn't check that tenant's financial statements. We couldn't have access to it. And we believe, and the sellers probably knew that something was wrong or something was up. And so it was quiet. So we didn't know. But the good news is it put us in a position to add more value. I realized we could bring in two more tenants, cut up the building, and add and increase the income to the building, which increases the value. And Starbucks was becoming big in Chicago at the time. If you can imagine that Starbucks was just getting started. And so we put in a bakery that used to sell goods, baked goods to Starbucks, and she did
Mm.
really well. And so that helped us with that deal. But at the end of the day, it's interesting because I got a call years later from the two icons in that are largest home builders. And they said to me, they said, "How did you do it?" And I said, "What do you mean?" They said, "How did you add so much value?" And I went through and they said, "Wow, that's amazing for your first deal." So a lot of good things have come from it and still running today. I'm in the prime of my career in commercial real estate, still love the business. And now I'm doing a lot of teaching. I do a lot of mentoring and teaching about commercial real estate.
Okay. So you guys have doubled down in the last decade or so on medical office, and so how about maybe speak to the salient points that make medical office properties particularly attractive and I think in your words resilient as well. Just any key points?
Well, medical office is recession and pandemic resilient real estate. And we own a tremendous amount in Florida, which has a big medical office healthcare market, as well as around the country. And what I noticed was not only that the human body is never going out of style, but medical office investing is cash flow positive investing. It's conservative investing with a lot of upside. And there's a large breadth, Kevin, of buyers out there that want to buy medical from you because once you polish it and stabilize it,
Yeah.
it has a lot of value for someone in a 1031 exchange, an investment fund that's looking for cash flow, that it provides excellent cash flow and great tax benefits. We do cost segregation studies on all our properties. And so we can create paper losses for our investors too. So there's so many benefits to medical office investing, Kevin, that it's a real attractive asset class. Now, it's not these cowboy deals. It's not like you're going to get rich off one deal. However, they're very, very stable, conservative, and do have upside when we sell. And so that's what the business is about. It's a great diversification play. It's great for cash flow and for people that have capital that are looking for tax benefits.
Got it. Is there any risk? And this is obviously just a subsector. I mean, medical office it spans a litany of different types of use. But telemedicine is obviously becoming a big thing, and surely will evolve over the coming years and decades. Is there any risk associated with that you guys start underwriting as it relates to not as many patients coming into a local practice, and so for that reason, they need less space, or maybe the doctors aren't even working on that practice anymore. Maybe they don't intend to in the next couple of years because they're going to literally do it from their iPad at home. Any thoughts about that? I don't know too much about that,
Yeah, I
about
mean,
that evolution of telemed. I just know
I'll
it's a
give you my
thing.
I'll give you my take on telemedicine because I went through COVID and I've seen it. I don't believe in telemedicine. I don't think it's going to outweigh
Mhm.
going to. You still have to go to doctors for procedures, gastroenterology, orthopedic, dermatology. People want to go in and actually see a doctor. That's human nature, and so it's very challenging for doctors to prescribe things over telehealth. You have to go in, you have to test plastic surgery, you name it. I mean, everything is very personal when it comes to medical. And because of that, they still preserve the spaces. And a lot of the tenants we have are doing different types of procedure. It could be dialysis to dermatology to neurology. And so you need to go in and see these doctors, and it's really a face-to-face personal. I know I was ill a couple of weeks ago, and there is no way they could have diagnosed that I had a bacterial infection over
Mhm.
over a telehealth type Zoom call. I had to go in, they had to test me, they had to see what's going on, they had to test my breathing. It's very comparable to everything else. So I think telehealth is great if but the problem is the human body is so complex that no one has all the answers. And so going in, sitting with a doctor, being tested, you have to use all the equipment they have. They're very heavy equipment and a lot of investment. And it will never change. It will never change because the human body is not going to change.
Yeah.
And so as we live longer lives, as we have, medical office is going to be even more prevalent. And technology is changing and they're changing with it, but you're still going to have to go into the office and utilize those services. We've seen it for decades. We've seen, between insurance changing in different environments with Barack Obama and him threatening socialized medicine to understanding telehealth to pandemics and recessions. At the end of the day, like I said, the human body is never going out of style and you're always going to need medical office. That's why it's one of the best asset classes we feel in commercial real estate.
Yeah, no. I mean, you've spoken to the durability of the income there, and just the stability that it produces. Obviously, it means that there's probably a lot of other capital chasing this asset class. I mean, to your point, there's obviously a lot of buyers out there looking for a good, stable MOB to acquire. How are you guys finding opportunities, and like what does the ideal look like? Ideal deal look like for you? Like, what's your buy box, and what's the perfect fit?
Well, I mean, for us, it is a competitive space, but there's high barriers to entry because you got to understand the business and how it ties into the community and the hospital systems, and every niche has different metrics that you got to understand. So, analyzing a dialysis facility and how well it does, and also how it deals with the government and reimbursements, is totally different than an orthopedic practice.
Mhm.
And so, in neurology, you have to understand the different niches. So, it creates this barrier to entry to get in certain respects. It's not for the faint of heart. And so for us, we look at areas where there is density. There's got to be at least 50,000 people in a 5 mile radius. We look for annual rent escalations to help with inflation as well as add value. And the nice thing about our business, Kevin, in the medical office space investing is we have high upper 80s renewal rates of our tenants. And that's a big plus to add a lot of value to our tenants and cash flow for our investors. And so we look at all the different niches. We look at do the tenants invest in the property. We look at how do they fit in the community. We look at tenant financial statements. We have a very in-depth underwriting and due diligence process in order to buy a medical office asset.
No, all good. And so, but beyond medical office, I know that you guys are also, you'd mentioned you just opened up a multifamily arm. I believe that you guys are still, correct me if I'm wrong, you're still investing in retail and industrial, and there might have been another one I missed in there. But just of all the other asset classes that you guys have verticals in, how do you prioritize, where your focus and energy is? I mean, or do you have truly independent divisions that are kind of doing their own thing?
Yeah, we have independent divisions that are doing their
Okay.
own thing, but we also are monitoring what's going on in the world and the economy. So
Hmm.
right now, industrial is a great asset class, okay, because of what's going on with manufacturing and distribution in the United States. And so we do a deep dive. We are like economists in Alliance, where we look at trends and we look at where things going and what's stable, what's a good place to put our investors' capital. I'll give you an example. We opened up a multifamily division in 2024 because I was in Japan about a year and a half ago. And I was there on vacation. I was thinking, and I was reading, and I was seeing all the debt that's coming due. And I had all these colleagues of mine that bought properties and multifamily in 2019 and 2020 and 2021. And the debt they put on was so foolish, these bridge debt. And I said, if interest rates rise, which they're probably going to, because of the current administration, I said, they're going to be in trouble. They're not going to be able to refinance, or they're going to be stuck. And that's when I realized, I said, we have a lot of people that have been in multifamily and our property management. We have the pedigree to understand it. I said, let's open up a division, hire an incredible person to run it, and we'll grow it. And right now, we're in the thick of it. We have a deal in Houston, Texas, 260 units. We're raising equity for and going to close. And it's a wonderful opportunity. And that's a distressed deal. We're going to see more distressed deals. So with trillions of dollars of loans coming due in 25 and 2026, we see great opportunities, especially in multifamily.
Is the maybe speak to the distress? We could use the deal in Houston as the example. Speak to the distress. Was it more distress on the sponsor side, as a result of the debt and the timing and just not being able to execute their business plan according to the original timeframe outlined, or is it a function of that maybe paired with some distress on a more localized property level?
Yeah, I think it's more of the sponsor. It's not really the term of the loan. They got plenty of runway. It's more about that the values have dropped.
Hmm.
So their basis, they're in at a high basis, values dropped, um, which means, and if vacancy drops a little bit, it's a challenge to pay your debt service, and that's where the struggle is. So for them, they rather just cut their losses and move on.
Yeah, no, God, I think there's a lot of that, to your point. There's a lot of that. There's a lot of that coming up. I mean, I'm watching my email in my inbox from various brokerages. I just saw something that came up in San Antonio, like a 4 or 5 property portfolio of multifamily. That's foreclosure, and there's going to be a lot more of that coming down the pike. How about just the capital markets? Obviously, the last couple of years, we've had rising rates. Hopefully, we'll get the Fed will do a rate cut here coming up at their next meeting, but. I guess just try maybe speak to how you guys have adapted or any pivotal changes you've made over the last couple of years as as the volatility kind of played out in the capital markets and uncertainty with rates and where they're going, how high they're going to go, are they going to drop? Have you guys made any differences in your buying decisions or how
Sure.
you structure things?
Yeah, I mean, seller financing is really prevalent in the
Hmm.
markets. We've seen a lot of those deals. Uh, we've seen the ability to get creative with our lenders, being put in more equity, which has dropped the valuation for property. So there's a balance there. Kevin, we see that that even deals we paid cash for, and then we went back out and put
Yeah.
financing on it. So we've done that too. So we've done a hybrid and a mishmash of a lot of different structures, and we've gotten very creative, which you have to in this market. But there was a lack of liquidity in the market, especially with lenders. We had to refinance properties, which we did successfully. Um, we've had to bring in bridge lenders for a few deals accordingly. So you have to get creative, and we feel that the market's going to change. And if interest rates drop, there will be an opportunity and more liquidity. Then we can handle some of the stuff that we did to carry us through a tough time. And so there's going to be tough times, hard times in commercial real estate. Not everything's going to go perfect,
Yeah.
but how you respond to the tough times is everything. And that's reflected in my new book because it's called Hard Assets and Hard Money for Hard Times. How you deal with things is so critical in building a hard asset empire, especially in commercial real estate.
Let's expand upon that a little bit. Don't use the first deal as the example. We've already discussed that one, but maybe share one lesson that you've learned from a deal that didn't go as planned.
Well, I talk about this in my book. And when I was younger, I bought a huge office campus in the Midwest, and we put on way too much leverage. And interest rates rose and changed. We lost 2 floors in one of the office buildings we bought, Kevin, and debt service coverage changed. So we end up becoming in default of our loan because of debt service. Even though we could service the debt with cash flow, it triggered a default. I realized we were over leveraged. We were about 88% leverage on 350,000 square foot office campus. And it was painful. It was a learning lesson. I realized we had mezz debt. We had a lot of different players in the deal. And I realized I'll never do that again. And
Mm.
ever since, I'm 65% or less LTV.
Yeah, yeah, us
And
too.
even when I go 70%, I'm kind of nauseous because I'm thinking about, like, is this the right thing to do? And so my advice to people, and I talk about this in my book, is don't over leverage. And also, Kevin, is that if you have to pay your investors a little bit less return to protect them and have the flexibility, do it. People will thank you for it. Yeah, I know. Maybe you're not paying them an 8 and you're paying them a 6, or you wanted to pay them a 7, but you're paying them a 5. It's okay because you're all about protecting their capital.
Yeah.
They're the priority.
What a great topic. We just talked about that quite a bit. My partner and I earlier we did an investor update on one of our funds, and it's interesting. I mean, you couldn't be more spot on. We're very conservative. I've been through this. I've been at it now a little over 20 years, and so I guess I could say this is my second cycle. But we are really conservative with debt, and it's interesting because when during the heyday, I guess you could say late 2020, 2021, 2022, when rates were at all-time lows, and everyone's just FOMO, fear of missing out, buying things, overpaying for it, putting risky debt in place, over leveraging it. We had a good we grew quite a bit in those years, but not nearly as much as a lot of our competitors. And the reason being is that we're much more conservative with underwriting, we're much more conservative with debt, and we couldn't, without over leveraging things, we couldn't really be competitive with the returns that we could offer. And so while the deals that we did buy, they have performed quite well, we might not have been able to squeeze out as much of a return as we would have if we would have put more leverage in place. But guess what's happened is when everyone else is losing sleep and losing deals, we haven't lost an ounce of sleep. We haven't lost a dollar of investor capital. We have never paused distributions. And so it's just really about protecting that downside risk, and our investors can sleep at night knowing that their capital is protected and it's invested very conservatively. And even in instances where there might be a devaluation, it's okay. There's enough of a buffer there, and there's enough of a time runway for things to right itself and not completely fall apart. So that's that's an interesting perspective. I don't think that's a perspective that a lot of the at least from what I see, like a lot of the maybe in the last decade, the syndicators that have gotten into, and not just multifamily, just into commercial real estate in general, it always seemed to be the more leverage, the better, and they're always really pitching higher returns. And the only way that you can pitch higher returns is by leveraging the heck out of something, right? And that became the focus and the framework of their investment thesis. And I think that's wrong. I just don't think that's
Well,
the right
I
approach.
mean, I think a lot of people don't understand the key of the business. Key of the business is ability to
Yeah.
hold, and the ability to hold. And that's what it's about. You got to be able to ride through cycles, which I've been through. And
Hmm.
so, in order to do that, if you over leverage, like you said, I'll give you an example 22, 23, rising interest rate market, right? Values are dropping, things are changing. Let's say you had a refinance. Because if you have 50, 65, 60 LTV on a property and the value drops a little bit and your 55 LTV now is at 65, you have a better chance to refinance and take
Yeah.
it out. And that's the real benefit is flexibility. You need, if you're going to put leverage on your properties, you need flexibility. That's a key. And so and flexibility comes in a lot of different ways with lenders. We're an expert with debt when it comes to putting on debt. But if my number one goal is I'm going to protect my investors, the last thing I'm going to do is put us in a position where we can't have flexibility and the ability to refinance and protect our investors' capital.
Yeah.
And I think other syndicators and fund sponsors and fund managers lose sight of that.
Mm-hmm.
And for us, it's a commercial real estate. It's a marathon game.
It's a
I don't,
long,
for everyone, yeah, everyone
yeah,
out there listening, I don't care what you say. It is a marathon game. It's not a get rich quick business. And so at the end of the day, you have to be patient, you have to be smart, and you have to be a good fiduciary with your capital, which is exactly what I preach and what we do at Alliance.
yeah,
It's so important. And so the ability to hold, whether it's reserves, less leverage on your properties, managing the asset properly, building relationships with tenants, you name it. All these things create the ability to hold capital.
yeah. I agree. No, I love that. I love every bit of that. You know, as we wrap things up, Ben, appreciate you coming on the show. I want to give you the opportunity to. I know you've got a podcast that you've been hosting for quite a number of years now. You just wrote a book, so maybe for those that aren't familiar with you, tell us a little bit more about maybe first and foremost the book, and then we can speak about the podcast and where folks can go listen to it.
Yeah, so I wrote a book recently called Hard Assets and Hard Money for Hard Times. For years, Kevin, I've been asked every day for decades, how do I build wealth? How do I invest in alliances, funds, and syndications? Can you look at my real estate portfolio? Can you look at this company I'm looking to invest in? And I said to my team, I go, we got to write a book because a lot of people don't understand how to generate wealth. That's what we've determined. And they don't understand assets, money, or time either, how it all ties in and their tools to building wealth and building a hard asset empire. And so I decided that I need to write this book. And I wrote this book for you, everyone. It wasn't about me. I didn't need to write. It took me about a year to write, a labor of love. And I give war stories in the book to show you, like, here's authentically what could happen. Here are the lessons I've learned, like the lesson I showed you about leveraging too much. These are all the things I talk about in the book. And I teach people how to build a hard asset empire, how to invest with smart money. And I teach and I give people a free blueprint, a free hard asset empire blueprint. You can download from my website, benreinberg.com. It's free. I give it away. It's because I want you to build it the right way. You're going to build a castle, fortress, and you're going to have a foundation. You're going to have keystones and capstones. I'm going to show you everything you need to do step by step. And I do that because as things change, I wrote the book for the Ben Reinberg who started 32 years ago to the billionaire who still uses my book. And it's for that diverse people. It's an evergreen type book where you could pull it off the bookshelf every day, every week to say, what do I need to amend? Because in the book, I show you how to build, grow, defend, and compound your wealth and also protect it, which is extremely important. We talk about data. So at the end of the book, Kevin, one of the things I said was mindset. I said, you're going to have to control your emotions and understand who you are as a person, become emotionally intelligent as you go through this. Because guess what? You're going to have to change attorneys, maybe accountants. Maybe you're going to have to change resources, fire employees. You're going to have to, some deals aren't going to work out as well, but you got to keep going. And all this is that emotional intelligence that I've learned throughout the years. But no one talks about it and teaches it when you're building a hard asset empire. And so that's our last chapter in the book. And then I went a step further. And I said, you know what? The book is great. It's evergreen. It's going to teach people. I said, but let's bring the book to life. So I decided, I said, you know what? We're going to do courses. And we're going to have 4 courses. And we're going to teach people about the book, how to build a hard asset empire. I said, all right, well, let's start with course 101. They're like college courses. I said, they're core fundamentals. And it's a step-by-step guide to the essential principles of building a hard asset empire. And I said, well, let's take them a step further. If they want to keep going, we're going to create course 201. And it's incremental growth assets. And it's strategies for steady and scalable growth of building your hard asset empire. And I said, all right, well, what if someone wants to go further? We said, okay, class 301 is legacy and vision planning, which is building a long-term legacy and strategic vision. And we said, well, some people are going to want to even teach this to other people and be certified. So we said, let's teach one more course. It's course 401, and that's advanced strategy. It's high-level tactics for maximizing impact. And so people say, well, why do the courses? Why read the book? And I'll tell you why. It's because I'm going to show you resilient cash flow strategies that no one else does. I'm going to show you how to invest in stable market opportunities that you're going to want in your portfolio. And then most importantly, I'm going to personalize and help you build your hard asset blueprint, which is your hard asset empire. And so it's a very reasonable book. The courses are priced very reasonable, and the hard asset blueprints for free. So if you're looking to build a hard asset empire and really understand wealth, that's what I did for the public.
Good deal. No, I love that. And folks can grab a copy. I'm assuming your website, Amazon. Where's the best place?
Yeah, you can go to Amazon and look up hard assets and hard money for hard times. You can go to my website, benreinberg.com. You could buy an individual book and you can buy in bulk. I mean, one thing we realized was a lot of accountants, registered investment advisors, as well as finance professionals, attorneys, are buying bulk books to give them out as gifts for their clients because they realize the value we're offering is tremendous, and it gives them an opportunity that they can help and support their clients. And so, and then you talked about the podcast. The podcast is now a TV show. It's called Ben Reinberg hyphen I Own It. And it's really a way for me to create impact and teach people about business and life. We bring on guests in studio. We film 13 episodes at each season, and it's going to be streaming soon on a local channel near you. And what is happening is that I do a front to camera where I stop the interview and I explain what the guest said to educate people. And so it's all about providing great education, great content, and really the ability to learn about business and growth, how people are scaling their businesses, how people are holistically creating themselves and their business and their personal life. So you can get a deep dive and feel like, hey, I'm going through the same thing that other people are going through,
Yeah.
or they went through this experience. Let me pull that experience and use it on my own. It's all about how I can add value to you.
Yeah, no, it's great. I've had the opportunity to listen to a few episodes, and you do a great job. So, guys, definitely go check that out as well. It's called I Own It. Is that correct, Ben?
That's correct.
All righty. Well, hey, one last question before we wrap this up here and say goodbye is, and I wanted to ask this earlier, just got off track. Is we talked a lot about just working through adversity, challenges that you're going to face if you get into this commercial real estate sector. Surely not everything's going to go as planned. Some are going to hit home runs on, and others, you might barely hit a single, right? But it should if you're. It's a marathon, as you had mentioned, and really the whole objective here is that it really does average out over time, and you just need time on your side, but. Speaking about the adversity piece of it, do you have a personal habit or some sort of mantra that you use to keep you grounded during times of uncertainty and during times of challenge?
Well, when I wake up every day, the first thing I do is I meditate.
Okay.
I ground myself. Um, I stabilize my central nervous system. I also do a tremendous amount of personal development. So I'm emotionally intelligent. I'm calm. I can handle adversity. I can handle tough times because tough times don't last. Tough people do. And so I said, how do I become the best version of myself? Well, I have to show up differently. I have to be a little bit more empathetic, a better listener. And meditation has helped me ground me to look at situations when people are chaotic, or things are chaotic, or stress. And I could take a step back from a 40,000 view and say, what's really going on? Because in life, for everyone out there, and I'm sure you have some young listeners out there, men and women, is that one thing I could tell you is when you're going through a challenge or a tough time, say to yourself, this shall pass.
Yeah.
Because think about a tough time you went through and look back at it. Things passed. You're at a different place in life. Things changed. Maybe a different relationship, whatever might be going on in your life, say to yourself, this shall pass. And if you know that you'll move on from it, and it's just a brief moment in time going on, and maybe it's stressful at the time, and you're looking at it through a lens where it's like, you know what, it's a little stressful and it's tough, but you'll get through it. And so I do all these things. I work on myself so I could show up as the best version for my leadership team, my investors, my employees, the public when I go out and speak. And so I do these things because when you're a leader and you have to teach and educate, you also have to inspire. Mm-hmm. And how you conduct yourself and how you're calm and balanced will help you inspire and help people grow. So you have to grow yourself as a person mm-hmm. in order to be able to provide that to the people that count on you and depend on you.
Yeah. No, I love that. Ben, this has been a very enjoyable conversation. Appreciate you coming on the show, sharing all your insights. Guys, we'll be sure to put all the links We'll put a link to Ben's book, to his website, to the courses you've referenced, to his podcast. Put that in the show notes. And with that, Ben, this is, again, pleasure having you here. Appreciate you coming on. Good to get to meet you and chat with you a little bit. And wishing you all the best as you guys continue on your trajectory, and wishing you the best with multifamily as well. Hopefully, there's some good opportunities that come your way here this next year or two.
Thank you, Kevin. Appreciate it. And thanks for having me.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.